Hey, I'm Kern Francis and welcome back to FinTech. So we're currently in one of the most volatile stock markets in history. The S&P 500 has dropped by as much as 18% and immediately risen by as much as 28%. And some individual stocks have seen even bigger swings in price. But with volatility comes opportunity. So in this video, I'll share the one stock that I just keep buying that I added another $1,000 to today, covering which company it is, why I keep adding to it, why I believe it's a buy. We'll cover all of it. We also have a lot of other news that's affecting stocks. The biggest being the newly announced US and Europe trade deal, which could impact parts of the market that benefit from lower tariffs. We'll look at what those are, as well as getting commentary from other folks such as Tom Lee on why he thinks tariffs haven't derailed the rally so far and what the effect might be going forward. Another thing that happened this weekend, the Fed had one of the first disagreements on interest rates that they've seen in the past 30 years. Interest rates have a huge impact, especially on banking stocks as well as other areas of the economy, so I'll be sharing my thoughts based on the expert analysis that I've seen on when this will likely happen and whether investors should be bearish or bullish when it does. And then we have a bunch of other stuff to get into. Palantir stock has been rocketing up in preparation for earnings. We'll be looking at that. And we had this crazy news about a series of major breaches against Microsoft, which is super serious for the cybersecurity market. So there's a lot to cover in our limited time, so let's just start with the one stock that I keep on buying. It's in the financial sector and the position is SoFi. I'm buying another $1,000 in SoFi today, continuing to build up this position because I am very bullish on this stock. The company just reported blowout earnings, and the company's stock price immediately jumped by as much as 15%, although it's given up some of those gains down to around 9%. But that underprices what SoFi just did. In their recent earnings, they showed that their number of members had stabilized at 34% growth year over year, which puts them at 51% compounding number of members over the last 4 years. But even more importantly, their number of products, since one customer can use multiple products, that has actually accelerated, up 34% year over year versus 32% growth a year ago. This is almost unheard of in the financial space, where SoFi is not only growing faster than ever, they are accelerating the rate of growth, which could give investors an opportunity to buy the stock cheap because a lot of valuation metrics assume growth is either solid or decreases over time. And so accelerating growth may give us the stock at a discount. But let's see how likely that is to be based on the business. So SoFi is essentially three businesses in one. They have their technology platform, which includes the Galileo platform, which actually runs some of their competitors' checking and savings accounts on top of it because it's just the best service out there. After that, they have financial services like the SoFi credit card, which basically gets people onto their platform, and then they upsell them to more valuable areas of the company like lending through their mortgages. This model is great because it diversifies the company, but it also comes with a lot of risk because most of their profit comes from the lending business. And holding these loans might not pay off if there's a big pullback or even a recession that hits the loan market. But the average credit score of these borrowers is way higher than the industry average. Their average student loan has a score of 768 with a personal loan score of 743. So what these numbers mean is that SoFi is more resilient during a market downturn because the type of customers they have already have more money than average. And we can see that their growing portfolio of products is actually growing their revenue even faster, with the company raising their 2025 guidance to $3.3 billion, a growth of 44% year over year. And what's really cool is this company is finally becoming profitable, expecting to reach $370 million in profit by the end of 2025, which means they could become eligible to be added to something like the S&P 500. Now, that all sounds amazing, but all that really means is that SoFi has diversified revenue, meaning if one area of the business drops, the other areas could rise. But there's a reason that SoFi is so worried about areas of their business dropping. If we look at the company in Forecaster, there are a few things about their fundamentals which are worth watching out for investors. Number one, if we look at their fundamentals, their price to fair value, basically measuring how expensive the stock is, has only risen over time. In fact, Forecaster lists the stock as 71% above the fair value. Now, that doesn't automatically mean the stock is overpriced. After all, if they have some kind of growth that is outside the ordinary, that would be a reason for the stock to be more expensive. And as we saw, SoFi's growth is pretty great. And if we look at Forecaster's solidity metrics for this company, including their Piotrowski F-score, the stock is in the stable range. Anything in the 4 to 5 is considered stable, while above 6 would be considered strong. So ideally, this company would eventually hit the 6 range, and their Benish M-score puts them at -3, which means they are extremely unlikely to be manipulating their earnings. Anything below 2 means they're unlikely to be trying to manipulate their profits to look better on paper than they actually are. And then their ultimate Z-score is something you can't use for a financial sector, and that's just a way to measure the company's health. So as long as the company can continue growing and they don't issue too many shares that it dilutes the stock, which has slowed down recently, but given the stock has now given up most of the gains that it made after earnings, it makes me a lot more comfortable buying into this company and potentially getting a decent discount on the stock today versus in the future. But let's now focus on some broader news in the market that will affect SoFi, both in terms of opportunities and risks, but also the other stocks that could benefit from this news. So number one, we're a few months into the federal government's decision to resume student loan collections after the pause for the pandemic. And this has resulted in the number of newly delinquent loans rising extremely quickly back to the levels we saw before the pause. And this shakeup in the student loan market can both help and hurt SoFi. On the one hand, you don't want people defaulting on your loans because that means you're not making any money back. And overall, SoFi's charge-off rate, which basically lists the percentage of loans that SoFi has fallen to delinquency and they basically lose money on, that has actually been trending in the right direction overall, but we have seen an uptick in student loans specifically. At the same time, it could be an opportunity for people to refinance their student loan with SoFi, although rates are fairly high right now. So that really depends on what happens with federal interest rates, which leads us to our next big piece of news, that the Fed has decided to hold interest rates steady, at least for now. See, one of the main ways that banks make money is through interest income, and the higher the interest rates you see, the more income a bank gets on their interest, which makes sense. If someone is paying 10% on a loan, the bank is making more profit than if they're paying 4%, so higher interest tends to benefit the bank in that way. And for the last basically 30 years, we've seen a steady decline in the net interest margins for the average US bank, with an unbelievable drop-off during 2020. But now with interest rates higher, banks have been making more money on this. So then the question becomes, what happens if the Fed lowers rates, which is something that the current administration has been pushing them to do? So for the most part, Jerome Powell has been pushing back against this, saying he doesn't want to cut rates. But for the first time since 1993, 2 of the Fed governors actually dissented with his choice. And a lot of experts right now are expecting that we may see a rate cut as early as September, which could affect SoFi's business going into the end of the year. Now, if we do see a federal rate cut, one stock that would benefit is VBK, which is Vanguard's Small Cap Growth Index Fund. This tracks small companies that are primarily valued based on their future growth, and lower interest rates pretty much universally help smaller growing stocks. But we can't talk about interest rates without talking about the overall economy, and Tom Lee thinks that tariffs are intimately connected with interest rates because tariffs directly impact the Fed's favorite metric, inflation.
Well, I think the economy, we've had enough data to know that the tariffs aren't necessarily hurting the consumer wallet or hurting jobs growth yet, but we're just waiting for, as Fed Chair Powell says, to see how it shows up in inflation. So I think the next 2 inflation reports are going to be closely watched, because if we don't see a meaningful pickup in core inflation and consumer inflation expectations don't move up, then it's going to give the Fed a lot more comfort about cutting over the next 12 months, and that would be good for stocks.
So to be determined if we see interest rates getting cut in a few months. But the other big news this week, the Trump administration has announced an EU trade deal which will actually reduce tariffs in the short term. This followed months of tense talks between the EU and the US, and it could provide an opportunity for certain sectors that will benefit from lower tariffs. VOO is a collection of all the biggest stocks in the US, and that is one stock that could benefit. And for my portfolio specifically, I could actually see Cloudflare being a major beneficiary of reduced tariffs, given the company now makes 28% of their revenue from Europe, the Middle East, and Africa. Meanwhile, in the AI space, we are seeing Meta go on an absolute spending spree, basically hiring up all the AI talent that they can and poaching a lot of talent from OpenAI. This was a big topic during the company's last earnings call. They talked about infrastructure and talent being their top priorities in the AI space. And overall, the market has so far been pretty neutral on this news. You can see that the stock is basically flat over the past 6 months, and it's actually down around 4% during this time when they've been investing heavily in AI. In some ways, this kind of looks similar to Meta's big push into metaverse technologies, when the company also saw some pushback from investors who thought they were investing in the wrong space. This drop was also due to the broader tech market selling off, but Meta's big push really validates one of my biggest investments, which has been in Google, which is up 10% over the past month, and I think will actually actually be the long-term winner in AI. Some people don't realize, but even though ChatGPT was sort of the first killer AI app, Google invented the foundation models that it's built on, and they've been pouring money into research as long as this company has existed. And the company has been very focused on multimodal models, meaning AI that can understand images, text, and audio all at the same time, which long-term is going to be huge for the AI ecosystem. And even companies like Palantir, whose stock price is up 16% in the past month, they're not designing their own AI models. They use the models that other companies create as tools to build their own business. And as Google is creating more and more valuable tools, I expect that companies like this will be the ones that are using them. But here's the craziest part for me. So tech companies traditionally have very high valuations. We can see Meta here has a Peter Lynch PE ratio of 566. That puts them fairly expensive. You can see Forecaster says they're 20% above their fair value. If we look at another AI company, Microsoft, they have a Peter Lynch ratio of 415, a little bit cheaper than Meta, but still very pricey. Then we go and look at Google or Alphabet. They have a Peter Lynch ratio of less than half of what Microsoft has right now, 184, which even as a tech company, Forecaster says is roughly where the fair value should be. And that is just based on the numbers, not based on any future AI potential whatsoever. So when you take Google's very solid financials and what I see as far superior long-term potential in the AI space, there's a reason that I hold a substantial amount in Google, and there's a reason that it's up around 18% as long as I've held it. And one other kind of fun note that I'll show, Forecaster, the platform I'm using, has this feature where they will track the seasonality of the stock over time. So if we look at this chart here, this shows what time of year the stock price tends to rise and drop. And we can see that historically it has risen in around October through the end of the year. Now, obviously that doesn't mean the stock will go up in the short term, but considering I like it as a long-term hold, that makes me feel pretty happy that the stock should continue to do well in the near term as well as the long term. And by the way, this platform is called Forecaster. I've started using them in basically all my videos, and you can check it out using the link below, and I think you also get 10% off if you sign up using that link. But the other big news this week is that there have been continued attacks on Microsoft SharePoint, and we've even seen some pretty big breaches. We're seeing a bunch of ransomware attacks occur with companies who use Microsoft SharePoint, as well as US nuclear and health agencies that were actually hit by this breach. This just underscores how important cybersecurity is going to be going forward, and CrowdStrike is one of my biggest holdings that addresses this area. The company's stock price is up around 34% for the year, and as we can see in their price, the company is very expensive, but that is also because the company has been growing absolutely insanely quickly, basically rising like an exponential over time. And since price is what you pay now and value is what you get in the future, I'm still pretty happy continuing to own this stock considering how much I think the market is undervaluing how important cybersecurity will be for the future. AI might be the big buzzword today, but I do not see a future where cybersecurity does not become one of the biggest investing trends of the next decade. Now, with all of these stocks, but especially SoFi, I actually think there's a decent chance, maybe 40%, that this stock price is actually lower in 2 years than it is today. It is a risky company, but I also think the price is likely to be much higher 5 to 10 years than it is today. Because regardless if the stock price goes up and down in a given period, the company itself is strong, and that is what I'm investing in. I know sometimes as an investor, I can sometimes get really excited about a new stock that I've discovered, but I always have to relearn the lesson that I should only move into a position slowly over time and not just dump all my money in hoping to make a quick profit. Because quick profits usually turn into quick losses, while slow and steady investing tends to win out over the long term. And let me know if I should make more of these sort of current event style videos. I want to make whatever is most valuable to you, so feel free to let me know in the comments. And currently, YouTube says that this is the best video to watch next based on your watch history. This is the one.